All right, folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. I'm back today with my buddy, Ryan Gonzalez, who is the founder and CEO of True Fiduciary Capital. I'll leave his contact information in the description below. But today, we're going to talk about ETFs, and in particular, we're going to talk about Ark Invest ETFs. Now, I turned Ryan onto this a few weeks back. He's been doing some research, and I'm really glad that we're talking about this today because Ryan is an Ark Invest skeptic. And we are going to talk about his concern. And look, I tell you guys all the time that I'm not trying to tell you guys what you want to hear. I'm trying to give you guys information that you may need to make informed decisions regarding your investments. There's going to be some hate from this interview. I can tell you that right away, but we're going to lay out what Ryan thinks is the truth. I'm going to lay out what I think this is the truth, and we'll let you, the viewers, make up your mind. So Ryan, I'm going to let you start to build your case, and then I'm going to systematically deconstruct your arguments.
If it pleases the court.
Sure.
So I'll start off and say that I'm not bullish or bearish. I'm cautious. Okay.
Right.
It's a still relatively young fund, and I'm not 100% on board, but all the material.
Let me make something clear. Are you looking at the Ark Disruptive Innovation Fund, or did you take a look at all their funds?
I looked at their main flagship fund for the most part.
Okay, so we're talking about Ark K. It's ARKK.
Correct.
Okay.
So that's the one that I looked at over the last couple of weeks. I mean, it's an interesting fund. It's very interesting. It's got it's got all the things on paper that you look for from an ETF. Or from a fund. I mean, it's got a great, easily told story that makes a whole lot of sense. Disruptive innovation. It all makes sense. It's great. Plus, you look at the great returns that they've had over a 1, 3, and 5 year period, just absolutely crushing it. And their social media presence is actually very big. So there's a lot of great things about this company. So the contrarian part in me looks at it and says, all right, everyone's saying kind of the same things about this fund, this ETF. Okay, let me look at it a little bit closer. Let me put my skeptic hat on and say, all right, does it measure up? And when I started going through all of the different facets of it and how I look at investing as a wealth manager, when I look at it from a risk, from a strategy, from a comparison standpoint, that's where I started to get a little bit more not on board with it. And not fully on board with it. So that's kind of my frame of reference. I look at everything from risk, strategy, comparison, and the fund manager. So that's how I look at it from an investment standpoint.
Can we cover risk first, though? What are you looking at when you make your comparisons? How are you coming to the conclusion that maybe it doesn't fit some of the risk parameters that you would like it to?
So good question. So when I look at risk, I use standard deviation. Okay. Standard deviation is a unit measure of risk. It's how we can put two completely different funds against each other and see what is their measure.
So I mean, just to make this clear, let me make this clear for my audience. So it's basically it's the unit measure of risk for returns that deviate around the mean. So you have an average return, a certain percentage are going to be over. The average, certain percentage are going to be lower than the average. So 68% of all your returns are within one standard deviation, and 94% are within 2 standard deviations.
Positive and negative, correct.
Positive and negative. So I just want to clarify that.
So the larger the standard deviation, the wider the expected rate of return. Right. And so when you're looking at it, when you're managing wealth on a large scale, you've got to take risk into account. So if someone is looking to need their money in 4 to 5 years because they're going to retire, a standard deviation of 50 is probably not going to be the best thing for them at this point. So that's the unit of risk measurement that I use is standard deviation. So when I started off looking at this, I said, okay, let's look at the fund itself. Let's look at its holdings. Let's look at its top 10. Let's look at the standard deviation, and the standard deviation is 35.5. Okay. When I look at 35.5, I'm like, all right, that's a pretty big number. To give you some context, the S&P 500, which this fund is always compared to, it's always crushing the S&P 500. The S&P 500 standard deviation is about 18. Okay. So it's twice as risky, all right, as the S&P 500. Therefore, looking at it just on the surface there, I don't think those two indexes should be compared. Because they don't invest in the same things. They're drastically different in their makeup, and they're different in what their overall strategy is. So that is like, wow, it is beating the S&P 500, but so is maybe emerging markets over 5 years.
Right.
So is big tech beating it over 5 years. So
they're not comparable on a risk-adjusted return basis.
Correct.
If you're investing in Ark Innovation, yes, you're invested in the S&P 500, and your Ark Innovation Fund is far outperforming the S&P 500. You might say, hey, I'm going to stick everything in the Ark Innovation Fund now, and then it gets crushed when we have a downturn far more than the S&P 500 does because it just takes more risk.
Correct.
Right? It has greater returns because it takes more risk.
Yeah, absolutely. And so when you look at it, when you look at the comparison between those two, and that's the flagship, what everyone says, it's crushing the S&P 500 as well. It is, but it's very risky. So right. that's the first thing I looked at. And then I started looking at, okay, that's the risk side. That's the unit of measurement or measurement of risk. Yeah. Then I looked at the strategy, all right, which is part of their story, which is, it's a great story. Is their strategy, they don't have an implemented defined strategy. They move across the board in whatever sector that they see value in, or what you call disruptive innovation. Now, from a wealth management perspective, when I'm looking at putting something in the portfolio, how does it fit and how does it go into that portfolio efficiently? When I hire an investment manager to, say, invest in small cap companies or mid cap or large cap or international, I want them to stay in their lane. I want them to do what they do best and not cross over. The reason I don't want a crossover is if I hire someone to do small cap business and they're buying large cap, then all of a sudden my portfolio is overweighted and the risk profile that we talked about earlier is thrown out of whack. So this being a wild card fund and moving big pieces all over the place at different times. I mean, Illumina a few weeks ago, they moved a $700 million position at the drop of a hat. This fund can do that. It has that flexibility, but at the same time, from a wealth management perspective, that makes me uneasy.
Okay, so I think you have a fundamental misunderstanding here about what Ark Invest is really defining when they say disruptive innovation, right? Okay. They're not really defining, like you're saying small cap is a sector, or like small cap value, large cap growth. They're saying that disruptive innovation is a sector of investment, and it's based on the whole concept of Wright's law, which is a manufacturing principle, right? They're not saying that a new technology that you put out by itself is disruptive. If you look at like electric cars, it's actually not a new technology. It's been around for 100 years, but really didn't reach the point of disruption until about 2005. And that was when really cell phone batteries, the fact that people were producing so many cell phone batteries using lithium ion batteries, that pushed the production of lithium ion batteries over a critical threshold that made it now very cheap to manufacture a battery large enough to move a car for 200 miles, right? They're talking about using Wright's law and how every time you have a cumulative doubling of production, it reduces the cost of something by a predictable percentage, by about 15% in the case of auto manufacturing, right? So that's really what they're talking about. And that goes across industries. And they talk about 5 different platforms within that, which is, next generation internet, genomic revolution, autonomous tech and robotics, and fintech.
Right. And I
so
understand.
They're more defined than you think.
And I get, but it's defined, but it's not defined, because when you buy large biotech companies that are not small cap, and I already own that in a large cap space, that's where the crossover is. So that's why I said it is a wild card. It's undefined. It's a blank sheet of paper. They think of what is going to be the new normal, which is what, one of their main things is what's going to be the new normal, and they invest in that. It could be a large cap, small cap, it could be international, it could be all of those different things. That's why that's what makes me uneasy about it.
There is going to be an overlap. That is
true. That's why I don't like the overlap. It makes me uneasy because at any time they could load up on Tesla, and I already own a lot of Tesla in one of my other sector specific funds. Then I own too much. So that's where the uneasiness lies. Not necessarily that I don't.
Everyone watching this, by the way, owns too much Tesla. If you're watching my channel, you probably own too much Tesla, me included. But that's just my watchers or my viewers. But that's okay. Like, we all realize that we're overweight. We all realize that we're taking a lot of risk in our portfolios.
Right.
I think though that your argument in this case, for the people that are investing, is they know there's going to be overlap. They know that the strategy that you're looking at is something that's completely different and completely new. I mean, the idea of Wright's law is not new. It goes back to the 1930s. But the idea of basing an investment strategy around Wright's law is relatively new. If you look at, what Cathy Wood has done, and I guess she started the Ark Invest in 2014 or something.
Yeah,
She's the one that first said we're going to have an entire company based around rights law instead of all of these other investment maxims. And that's really been sort of the core of her returns. Now, I want to, when I'm thinking of Ark Invest now, I want to throw away the past returns she's had, right? I'm not going to think about the past returns that they had. They're very impressive, don't get me wrong, but that doesn't tell you anything about what they're going to be doing in the future. When you look at their investment choices, though, and particularly when you look at the companies where they hold like more than 5, 10, and sometimes more than 15% of a company inside of the ETF, they're showing a remarkable, and I'm talking about, Tesla. They have 10% of the Ark Innovation Fund is Tesla, right? But if you look at their Ark Genomic Revolution Fund, it's Ark G, Invitae is a huge portion of that fund, but they actually own 18% of Invitae altogether. So you have, an investment firm who manages money that owns 18% of this firm. You and I both know there's a lot of paperwork and there's a lot of oversight involved with that, right? It's not easy for a mutual fund company or an investment firm to own more than 10% of a firm, right? There's all kinds of extra things they have to do. This to me represents an enormous commitment and conviction in the success of that company. And that's one of the things that Ark Invest is really doing differently than, say, a lot of other, like a Morgan Stanley is not going to do that. They're not going to take 18% of a firm.
But let me go back to that. Let me go back to what you said earlier. Is I want to throw the past returns out. Okay, I want to, and that's where I got into my one of my third levels is comparison, because if we're looking at what it's invested in, what it's invested in, how it goes about doing things, how it goes about picking stock, and you said a couple minutes or a couple seconds ago about owning large stakes in companies, showing a lot of commitment to it. I mean, they were there with Tesla, 5 years ago. And so when I looked at their portfolio and I looked at their rate of their returns, and they're 45% over 5 years, my question is, are they riding Tesla to Tesla's coattails? I mean, yes, they made a big investment in it and they held it for a long time. It's up 690% for the year and 66% over 5 years. So if you look at their 5-year number, tied mostly to that one or two large plays that they've had, okay, it's explainable. The question is moving forward, can they continue to do that? Are they a victim of their own success? That's one of my questions about
that is a concern.
Are they a victim of their own success? If they become like a private equity where they're just looking for that one big return out of 9 investments that they make, then that's what they're looking for. Are they going to start chasing returns because they're not able to keep up those returns and start trying to seek alpha in other ways, getting more and more risky along the way? With a new fund that's 5 years with no, like I said,
how could they get riskier than they are?
How can they get riskier than that? Well, they start moving down the risk scale and taking larger bets.
When you look at all of their holdings right now, I think they've got almost $2 billion invested just in Tesla at this point.
Yeah.
So, I mean, that right there represents an incredible amount of risk.
It was at some point upwards of 18% of their total fund until they divested from it because they didn't want it to get too big.
Yeah.
But when they've gone from 2 billion to I think 8 or 9 billion in assets in 1 year. So they're going to become market movers at some point, and chasing returns it's a real thing. They're chasing returns. They're dialing up the risk in order to continue to reach those gains and take more and more risk into the profile. So that's human nature. And I don't think it's avoidable. That's one of the other reasons why I'm cautious on this fund so early in its career, having such it's such an amazing success. Look at the returns.
But and you and I both know that and if you go back and look at the history, there's something called the SPIVA persistence report, where it just shows what is the persistence of outperformance of any fund manager. And basically 80% of funds out there don't outperform their index, although it
was 96.
Was it 96 this year?
It was 96%.
This year. That's the highest in a long time. It was 88% in the prior year. And it typically it's anywhere from 80 to 88%. So that would be higher than average.
Yeah.
But typically you have, anywhere from 80 to 90% of funds not outperforming their index over any given year. Not only that, if you look at those 80 to 90, or those 10%, 20% who did outperform the index, and you basically write all of them down, and 5 years later, you check and see if those same guys are still outperforming their index, the answer will be no.
Yeah,
like less than 1% of the funds that are fund managers that outperform their index in 1 year will still be outperforming their index 5 years from now, or won't even be really, or it's actually less than 1% would be in the top half of their peers. So this is a concern, like the persistence of management outperformance, consistency of management outperformance has basically not been shown in the data. And that's one of the things I'm concerned with too.
Right.
I am saying that she has a different way of looking at investments. Like I said, based on Wright's law and the theory of disruptive innovation, forming an entire firm around this philosophy is something that has not been done before. And I'm curious to see, what exactly she's going to be able to do in the future. I think she may be the one who actually breaks that mold. Like Bill Miller was that guy who broke the mold. He did 20% returns over 20 years. And I remember I saw an interview and he said, this is when that article came out, he said, this is the worst thing that ever happened. Now it'll never occur again. Well, and he was right.
Well, you had Peter Lynch, for the Magellan Fund, just outperforming consistently. But then you also had the Bond King, who from Putnam, that had a really good streak, and all of a sudden, no one heard from him after that. So you have both sides of that coin. Now, I did part of my analytics is I'm able to put together like what if portfolios. Right. And so I look to see, when a comparison, how is this doing, what to compare it to? Can't compare it to the S&P 500. Can't compare it to the Russell 2000 because it moves all over the place. So I tried to figure out what can I compare this to see, is this a good fund to own over the long term, or is there something better, less expensive that might reduce risk? And so what I did, this was kind of a fun exercise for me. I did this just for you, and I can send these to you for.
I definitely want to see this.
So I'll send these to you.
I never met a chart or spreadsheet I didn't like.
Send these to you for some light reading this evening. All right.
Sure.
So what I did is I said, well, what if an investor just bought the 5 big S&P 500 funds? Okay, so if you bought Amazon, if you bought Apple, Facebook, Netflix, Google, and you just own those, okay? So it turns out if you just put $10,000 into each of those and just let it ride, you would have been, let's see, where was it? Just gives you a 34% rate of return over 5 years, okay? Yep. So 45% with Ark, and with just these 5 individual stocks that have carried the S&P 500 for a number of years. Without these stocks, the S&P 500 would have been negative, a 3 or 4 out of the last 6 years or something along those lines. Yeah. But 34%.
Yeah, I don't think people realizing I'll edit in a graph that shows like how much those 5 stocks make up of the S&P 500.
Yeah, it's huge.
Do this because I don't think people watching this realize.
No, it's massive.
Yeah, it's massive.
All right. So going back, so if you would receive a 34% rate of return over 5 years, but you would actually be taking about 30% less risk than the Ark Fund. Just owning those 5 companies, 30% less risk, and roughly a 9% difference in rate of 10% rate of return difference. That's significant. Now, here's where the other side of the coin, or another exercise that I add is like, what does just adding a little sprinkle of Tesla do to that? Okay. Yeah. So I added every other position is $10,000. This position, Tesla position, $5,000. So 0.5%. That pumps you up over to 38% rate of return, and you're still taking 30% less risk. So is this fund a good fund, or did they just essentially bet on the right horse and go all in with 10-5 and hit a full house? That's the question that keeps me from being all in on this. All right. Is that specific exercise to see owning 6 things puts you just there with 30%, within 9% and 30% less risk from a
what's that 9% compounded over 5 years on a $10,000 investment? And what is the difference at the end?
It's a level of risk though. You got to look at the level of risk,
but it's also a lot of money.
Yeah. It's a lot of money, but
did you invert the sequence of returns too?
No,
that's a good exercise.
All right, so I'll get you that one too.
Yeah, you can invert the sequence, not just invert the sequence of return. I'm talking about make everything negative and see what happens too.
All right,
to the fun, and
that's an
interesting exercise.
And that's what I did when looking at this from an objective. Where do I want to put? And just looking at the returns, I want to put it in my allocation. I'm trying to figure out where can I put it? How do I weight it? And because I could definitely like telling the story. It sounds great. It makes a whole lot of sense, and it's innovative. It's new. It's sexy, other than just, the normal 14 or 15 indexes.
I'm thinking you don't understand it though, because you're just old now.
Is that how we do it now?
That's right.
I just need to know where to put it and how to weight it correctly, so that I can feel comfortable that my client's level of risk doesn't get skewed over a period of time. That's what they hired me to do, is to manage their risk and manage their wealth. And with something that aggressive that can move laterally between a lot of indexes and companies, that makes me leery of the fund. So those are my reasons.
So those are good reasons. Now let me deconstruct something real quick when it comes to managing risk. We are so the only thing really constant about life in general and the investment world is change. Everything is always changing. But I can tell you one thing, we are entering an age where things are going to change faster than we've ever seen them before. And we're entering an age where we're going to see more enterprise wealth destruction than we've ever seen before. We're going to see new things rise, like the electric vehicle world is basically going to destroy everything related to the internal combustion related engine. I'm talking everything from, like, where are Jiffy Lubes going to go? What's going to happen to your gas station? If 70% of people can charge their vehicle at home, do we really need 5 million gas stations? I don't know how many gas stations we have, but it's a lot. They can't all be converted, to charging stations.
Right.
But it's not just that. Genomic medicine is on the rise. This is a whole new area. And if you are just invested in an index mutual fund, and all of these companies are really like smaller or not necessarily reflective of the American economy now, you won't get any of that coverage. Like right now, Tesla is not even on the S&P 500, at least not until December 21st. Mm-hmm. So we've missed out on $500 and something billion of value for being included in the S&P 500. This is a really big deal, man. And I think if you're just strictly keeping your clients on, with the traditional sectors, small cap value, mm-hmm. emerging markets, large cap, mid cap, all that stuff, I think you're missing out. Like I would say that this is really a new asset class.
Right. And I understand. I have, and that's why I'm a big fan of ETFs, because you can exchange traded funds, because you can get laser focused in what you want. I have percentages in China tech and Chinese medicine, in cryptocurrency. So I have other asset classes and those weighted, and I'm just trying to figure out where can this new asset class, where can it fit in? And if so, how much does it get weighted? So that's not to say that
I would say this, it's actually a hedge. It's not so much an investment. It's a hedge against wealth destruction in other industries.
I looked at it as that type of model as well. And I looked at, because I have in the past used hedge fund trackers as a non-correlated asset. And I have used that in the past. So I was looking at this as something along those lines, but it doesn't fit inside the box.
Yeah, not exactly.
It's a different animal. And so that's where if I'm going to put 2, 3, 5% of my portfolio into this new asset class, I better be sure as to what's in it, how it's going to be done, and I need maybe a little bit longer track record.
So that's the great thing about ETFs too, though, is they do daily reporting of all of their holdings, not just the top 10. And that's the great thing. When you look at mutual funds, you don't necessarily know everything that they have in their holdings. It's a totally different story with ETFs, which is why a lot of actively managed funds fund companies don't do ETFs, because the reporting requirements are just a little too onerous.
Right.
If you can go on every day and look at Ark Invest and see exactly what they have, you can compare it to the day before and see what trades they've made.
Yeah, their transparency. I mean, their transparency. I mean, you have people just looking at that and buying exactly what they do in the same percentage. They're transparent as much as anyone that I've seen. So again, it's a great story, great returns. I'm just cautious.
No, I understand your caution, but I would say, that this probably needs to be included in most investment portfolios these days, something like this. And there isn't anyone else really who is doing something like this, using this particular model, based on rights law. Mm-hmm. There just isn't anyone else doing that. And I think, like I said before, it's really a hedge against things like the destruction of car ownership as a principle, right?
Mm-hmm. Which is a big market.
It is like we may exist in a future one day where most people don't own cars. We have a subscription to a car service. Now, if you have your, through your S&P 500 fund, you're invested in Ford, you're invested in GM, but they don't make the leap to a car subscription service that's based on like autonomous driving. They can't make that leap because they just can't get on that technology bus. Then you haven't helped out your clients at all. You know what I'm saying? Like,
oh, I get
this is a hedge against that sort of wealth destruction. And we are entering an age where that's going to happen more and more rapidly. Things are changing so quickly. And I try to explain to someone else who doesn't understand what's happening to the oil industry. I'm like, everything connected to the oil industry, there's going to be some successes because roughly 26% of the oil industry is not related to energy and not related to transportation. It's chemical uses that have some use beyond energy and transportation. So there's going to be some survivors in the oil industry. But most companies that we know of in the oil industry will disappear in the next 20 years. Because 49% of all end-use petroleum in the United States is just light passenger vehicles. So how do you hedge your client portfolio against that risk? Well, I don't think it's risky.
At the same time, though, you're looking at 10, 15, 20 years down the line, investing in that technology now, which makes sense. There's room for that, and it should be in your portfolio. However, if you're not looking at 3, 5, and 7 at the same time, you're also doing a disservice. So it's a delicate balance that you can't just invest in companies 10, 50. They're going to revolutionize things 10 years from now. You have to still look at, or else you won't have any clients because you're investing in something that's not going to give you a rate of return over the next 3 to 5 years. And so that's where you have to look at the balance between the two. And that's why when you're looking at where does this fit in as a hedge, as its own standalone, as a new asset class, you have to be comfortable with the amount of risk that you're taking over the next 3 to 5 years. And then so that you can see those returns 10, 15, 20 years when your doomsday does happen.
It's not a doomsday. I mean, look, I'm sure candle makers were really
it's logical.
I'm sure candle makers were really concerned about the light bulb. And like saddle makers are really concerned about the car. I'm sure they lost their jobs, but the world didn't end; it just changed.
But people still bought candles and still do, just not in the same amount.
It's just not in the same amount, just in tiny amounts. If people are going to still buy oil, it's just going to be in tiny amounts.
Tell that to my wife. Tell that to my wife. We have candles all over the place. But
excellent.
But no, I'll be looking into Ark. I'll be following their returns, follow their returns and their news. But everything out there is good news and great story. But I put my contrarian hat on and said, let's pull it apart and see if it lives up to the hype. And so far I'm still unchanged. I wouldn't say I'm adding it to the portfolio right now, but it's on the radar, and it's on the radar with about 2 or 3 other funds that are more laser focused in other things. So
we'll have to go more in depth into some of their other funds later on. There's a lot more going on there than just the Ark Innovation Fund. Right. But I wanted to bring you on because I knew you'd give me a contrarian view. Yeah. Most of my viewers, and me included, I'm a little biased. I absolutely love their philosophy. I have an enormous amount of respect for Cathy Wood, the founder. And it's good for me to get a shot of reality too. It's good for me to get an opposing opinion. So I think this would be a good place for us to stop for today.
Perfect.
And I wanted to thank you very much for coming on. And you guys in the audience, you can tell us all how wrong we are in the comments below. If you want to contact Ryan, then I'll leave his contact information in the video description. Thank you very much, guys, and have a nice day.